obviously that's a non-starter. Right? So typically that's what's going to happen in this process. Again, we'll rarely walk in blind to a pitch in terms of what valuation should be. All right. Any questions on valuation and its use in the pitch context? And this is where we need to also be a little bit careful, and I touched on this yesterday. Going in with a really aggressive pitch valuation might allow us to win the business, particularly maybe from an unsuspecting board or management team. They haven't gone through this process before. They see one bank that's way above all the others in valuation. They might take the bait and go for that. Well, at the end of the day, though, the investment bank kind of needs to deliver on that number. And that's where we said yesterday, that's where aggressive pitch valuations can be problematic. If we get 3-4 months into the engagement, and all of a sudden valuation is half of what we said in the pitch, again, that's an extreme example, but if we're materially different than what we pitched the company on, it's obviously going to cause some problems. Right? So typically what happens in these situations is all the investment banks come in, they all have an understanding of where the company expects valuation to fall out. Let's say it's $500 million. Typically what banks will do is they'll all come in slightly above that. All right? Enough above that where it wouldn't be so bad to back off on that if they were to win the business, but not too far above it where they're an outlier. All right? So if they come in at, say, $550 million, $525 million, maybe 5 or 10% above, that's pretty acceptable. If they come in at $1 billion, or if they come in way low, obviously those can be non-starters. All right? Or if they're way high, it can be problematic down the road. Does that make sense? And that's where a lot of times analysts, associates, as I mentioned way back when we talked about valuation, that's where valuation numbers need to get managed, quote unquote managed. Right? Like I said, it's rare for an analyst or an associate to start a valuation exercise without knowing where they need to come out. And a lot of times our selection of multiples, our selection of discount rates, our usage of things like company-specific risk premium, those items, that's what will influence those, is so we can get to the range of numbers we need to ultimately put in front of a client. Makes sense? Like I said earlier, we'll also at some point be talking about the process. Right? So if it's an M&A sale assignment, we'd want to be talking about how, what those first couple weeks, couple months might look like in terms of gathering materials, putting together our CIM, putting together our teasers. We'll talk about how we're going to reach out to potential buyers, whether we're going to go out as part of an auction process or maybe it's a little more of a controlled sale, that type of thing. We'll talk about how long we expect each step in the process to take. We'll talk about how long we expect the overall process to take as well. Really, ideally, give the company a good idea, a good roadmap of what to expect if we were to be hired, what steps we're going to take, how long it's going to take, and obviously, just like with valuation, if we're goosing the numbers a little bit, we're probably going to show an accelerated timeline as well, because like we said yesterday, speed can oftentimes trump valuation. Companies, when they get into this process, they want to know that the deal can get done reasonably quickly so that the market doesn't fall out from under them. There also, at some point, will be a discussion of who the bank would expect to be buyers or investors for a particular offering. And again, this is another opportunity for the banker to demonstrate their knowledge of the space, understand within the pharmaceutical industry, for example, who is particularly acquisitive, who's got the capability to do deals right now, who might have just done a large deal and is still digesting or integrating that, and maybe they're not going to be the best group to approach for the transaction. Right? So it's a great way to show our knowledge of the space. It's also a great way to miss something and create a problem for ourselves. All right? So typically we're creating very, very extensive lists. We're throwing in everything except everything but the kitchen sink, so to speak, in terms of our list of potential buyers. The last thing we don't want to do is miss an obvious buyer. And I've seen this presented a number of ways. A lot of times I've seen it presented in the form of a matrix where basically we're giving, for each buyer, we're giving a description of their business. We're talking about strategic buyers here, competitors, folks in the industry or related industries. So description of their business, where they're located, what their financials look like, and especially what's their liquidity right now. So do they have a lot of cash? Do they have a lot of availability under their bank facilities to finance an acquisition? Is their stock price at a level where it would be feasible for them to use that as currency in the deal? All right, so the higher the stock price, the less stock they have to issue, the less dilutive the deal is, like we talked about yesterday. So that might be one way to gauge capability of one of these buyers to close a transaction. Really important strategic rationale, fit. Think back to the Microsoft Yahoo discussions, the M&A discussions, say a year ago or so. Really a tough deal from a strategic and cultural fit perspective. The Yahoo folks really were against that deal. They probably would have lost a lot of their employees had that deal ever closed. There's obviously an issue with valuation as well, but strategic rationale and fit are very important. It's important that the banker can demonstrate their knowledge of what deals might work, what deals might not. All right. Details of recent acquisitions goes back to the knowledge of the space. Who's busy acquiring, who's been traditionally acquisitive, who is not, will give us an idea of what the most likely buyers could be. And then very importantly, perhaps even most importantly, who does the banker know in that space? Right? Do they, perhaps play golf every Saturday with the CEO of the most likely buyer? Like we said earlier, banking is a relationship business. That alone might be enough for Goldman or Morgan Stanley or whoever to win the business. The fact that they can immediately pick up the phone, call the most likely buyer, and quickly broker a transaction. Again, that was for strategic buyers. We'd probably also give some information for financial buyers if it was a situation where it could be a leveraged buyout. All right, or even if it's an IPO, who might be some of the large institutional buyers for the shares? All right, and what relationships might we have with them? All right, so what type of fund might this group be? Is it a venture fund investing in early stage situations, or a buyout firm? Maybe it's a turnaround firm investing in more of restructuring or distress situations. Where are they located? That can be important in the buyout or even the venture industry. A lot of times, buyout funds don't want to do deals that are more than, say, a 2-hour plane ride away. They want to be close. They want to be able to manage those portfolio investments closely, and they don't want to be investing in Boston if they're based in Newport Beach or something like that. Right, so that can be important. How big are they? What's their AUM, their assets under management? Real importantly, what is their fund availability? Okay, maybe they're fully invested on their last fund. If you think of the situation right now in private equity, it's a very difficult fundraising climate. So if a private equity firm has to go back to the market and raise additional funds in order to be able to do a deal, it might make them a long shot in the process. So that can be very important. Average investment size, that can also be very important as well. Groups like Blackstone, like I think I alluded to a few weeks ago, Blackstone's latest fund, which a year or two ago I think, was $20 billion. So when they go into a deal, they're not investing that in little $10 million pieces. They'd never get their fund fully invested. So certain deals, by virtue of their size, may preclude certain financial buyers from wanting to be a part of those. Right? Private equity firms, like I said before, they're motivated to get their fund fully invested, get back to the marketplace as quickly as they can, raise ever bigger funds, because those management fees, that revenue stream from the management fees gets bigger and bigger. So they don't want to be making small transactions, small investments at a time. Targeted industries, should go without saying. Certain funds might only want to look at industries with which they have a particular expertise, particular knowledge. Financial requirements. You see this a lot in the middle market and lower middle market funds, that they want to invest in companies that have, say, EBITDA between 2 and 10 million, or EBITDA from 10 to 50 million, or something like that. They're really going to target companies of a particular size, because at particular EBITDA levels and the application of multiples to that would imply transaction sizes that fit their needs. And then overall investment thesis. What do they hope to accomplish? How long do they want to hold their investments? What type of returns are they looking to achieve? Maybe it might be a 20% IRR with, say a 2.5 times on cash invested within a 3 to 5 year period or something like that. But it would be presented very similarly to how we present our list of strategic buyers. All right, so again, pitching, very, very important. You can spend half or more of your time in these marketing roles if you're an analyst or an associate. And if you're an MD, MDs are spending pretty much all their time bringing in new business, networking with former clients, networking with new clients, trying to get banks invited to those bake-offs so they can be a part of the process. Like we said, banking is a relationship business, very, very important, as is a bank's reputation for doing a particular transaction type. Think of Lazard and M&A. All right, bank's specific industry and product expertise, very important as well. Right. Valuation, again, always a big role in the process, but can be dangerous. Banks that go too high on valuation may have to later backpedal and create a big political problem with the clients. Some engagements might be determined by fees. That's typical, really more of smaller transactions, middle market, lower middle market deals. You don't see that so much in large transactions. Fees are pretty standard. Generally speaking, sell-side M&A is probably going to be about 1%. If you're on the buy side, it's probably going to be roughly half of that. Maybe 1 to 1.5 on the sell side, still roughly half of that on the buy side. All right. And then finally, the practice of pitching research no longer allowed. What do we mean by that? I think I alluded to that in class 1, but what do we mean by the practice of pitching research? It became really prevalent back in the tech heyday of the late 90s, early 2000s. Tech bankers, if they were going in pitching to win IPO business, they might bring a research analyst in tow with them and say, if you give us the business, we're going to cover your stock favorably for the next 3 years or so. We're going to keep a buy rating on your stock. All right, CEOs, boards of directors, compensated based on stock price. Obviously, that can be valuable to them. Obviously, there's a major conflict of interest there as well. So that was eliminated several years ago now. The practice of pitching research, strictly forbidden. It's part of that Chinese wall discussion that we had in class 1 and why the banking side of the house might be separate from the research side of the house in a bulge bracket firm. All right, well, that's all we have on pitching.